Okay.
Okay, amazing. So, okay, now I think the most important part now is how do we enter in these type of trades? How can we prepare? I'm not saying because this is hindsight, but how can we actually prepare to get into moves like this, right? And one thing I like to personally use is the cross of the moving average. I know it sounds corny because you have to differentiate between two kinds of environments. How to identify a real trending move and a not so trending move, right? And if you look like periodly, right? Like let's take a 5 minute chart and look at it from a period. From here to here, basically, all you had to do was sell side, right? All your business in this period was sell side because the orange line was basically above the blue line. We keep it really stupid, right? Like simple and stupid. And this is the thing. You would just try to sell into these green candles, right? So at the close of this green candle, you would try to sell. You would try to sell at the biggest volume candle at the close, right? So, and everything that goes beyond this. In this case, perhaps you could try to sell this order block, right? But we already know we actually we can be sell set because of the RJ, right? The RJ was sell set in this case. The RJ was here. This is Friday, actually. This is Friday. RJ was this here. This candle here was RJ. So I don't forget. So basically, it's okay. It's okay to be a seller, right? It's okay to be a seller, but what is more important is to see how is the trend changing in this environment because there is nothing going on, right? It is selling, obviously, right? It's not making any higher highs, but it's also not making any lower lows. And this is what we need to see. We need to see who is, I'm going to make a text, who is weak and who is strong. We need to identify this. It's important, right? So we're on the
Yeah.
5 minute,
Okay. If
but
we
the
if we
five
look
minute
at the last toxic move, so
exactly. This is how we identify it, right? This is how we
yeah.
identify because the last toxic move is obviously in this session. I'm just talking about the session, this one, right?
Yeah.
This
Sure.
is the last toxic move because of this big down candle. But what happens is that there is no follow through. The price is not going any further. The price is coming right back to where it was. And this is where the problem comes in because now you say, the price went down in maybe 5 or maybe an hour, right? Let's take 1 hour. It's less than an hour. It's half an hour, right? And it took the price to come back in 1 hour. So something is wrong here because this is like this looks already wrong, right? This looks like somebody. We remember the commercial, right? The commercial who's buying on dips, not selling on dips. We have to kind of understand this is highest volume of the day. This this area, right? So even though this is our RJ for the whole day, we need to be mindful that this is biggest volume of the day, right? This area here is biggest volume of the day. So we need to find out what are they doing with this volume, right? Who is weak, who's strong? Who is weak, who is strong? What are what are they, commercials, doing with the volume? This is important. This is the important part to a trade. What are they doing with the volume? It's a down candle. We know commercials buy this candle. This is a green candle. We cannot say that the commercial is actually selling this candle because why would he sell after, right? So this is incomplete on a 15-minute, on a 30-minute chart. It's a big buy, right? So we have to we apply the strategy on all time frames, like because it's fractal, right? We had this kind of order block here. Now you can really say, okay, this looks like a fantastic buy trade. because highest volume of the day into an order block, right? The trend is at the moment on a higher time frame, bullish, bullish, bullish. And why would we like to be bullish? Because there is liquidity above here, right? There was liquidity here. In this case, I'm going now on daily, and we have a higher time frame target that I actually wanted to get hit before starting to look for sells. That's why I was not really keen on the sell side. Here, I like quite the sell. I like the sell. I like even the push into the sell trade on the Friday. I even like this one because this will give us then the narrative for next week, right? Because we know, okay, this is a higher time frame key level. Let's see what they will do here. Why did they pull away this liquidity? I know why. Because there are so many stops. Look, just look at the stops, right? Here, here, session stops, here. Like this is big paycheck. And this is why the price ran through aggressively, because they ran out of time, because this is in the evening. They only have, look, 1930. The accumulation took part 1730. They had only, let me take the projection tool. The projection tool is where the measure tool. I just take the measure here, right? From 1730 to market close, they had 5 hours. Less than 5 hours, because they need to also close their positions, right? So 3 hours, give or take 3.5, right? They had 3 hours to run all these stops, and they did this in quite an aggressive fashion. So now we know, basically we know, okay, commercials are long here. I also want to be long, but I don't want to be long with commercials. I want to be long after I can actually place a good stop, right? So we identified this period here. On the 5-minute, it's sell side, but we also are kind of aware that there is a commercial sitting here. So when there's a commercial sitting here, we actually look for bottom edges. We look for retests into bottom edges, right? And then we see the reaction. Like for example, this bottom edge here, this was funny because price came up, it failed to take out this high here, right? They induced liquidity here because now there is a kind of vacuum of liquidity here, paycheck, right? Like, and why did this here not go above this here? Because they create this vacuum of liquidity basically, because every seller puts their stop here where the red box is, right? And the sellers here on this here, they also put their stop above here, right? When the price is going down, they say, oh, nice, I'm in profits, right? So this is just a vacuum of liquidity, right? Even also above here, like here. So what happens is price makes an high, retraces. So what happens? Interesting enough, we again get this red box here and we get stops here. And then we even get stops twice here, right? So let's make it one large bar, basically. So you can already see commercials buying on downticks, buying the downticks, buying the downticks, buying the downticks, even inside here, buying on dips, right? They buy on dips, and all these people are currently Momo, right? They're all momentum trading. They say, oh, RGL sell side, I'm just going to trade sell side only, right? And this is how they gain the liquidity, right? Because everybody is sell side, somebody has to be on the buy side. Who's on the buy side? The market makers. The market makers are on both sides. We always have to remember that they're on both sides because they sell as price goes up and they buy as price goes down. But in this case, they're more selling candles actually than buying candles, right? You would agree with that, like from 1430, like from the high volume candle. From here, basically, this is like a big spike down. We get a big spike up, we get a big spike down, we get a reasonable move up, reasonable move down, up, and then just downside, right? But it's starting to get slow. Like the pressure action starts to get slow, and this is where we are starting to become curious. Why is the price action slowing down? There needs to be a reason, right? Like the reason is, why are they accumulating? Why would they buy here, here? Do they have any reason, right? Perhaps one reason is fundamental, right? Fundamental. War, for example. People are scared. The second reason, and more important reason, important, is value. Value is the driver. Driver. Value is the driver. So we can now look at a couple of values. For example, if you trade gold, you look at 6J1, right? The Japanese yen futures, and you see if people are actually buying the Japanese yen. Let's see. Are people buying the Japanese yen at that day, right? Did they buy it? Yes. They bought a lot of Japanese yen because risk, right? Okay. What is also a safe haven? The Swiss. The Swiss, right? The Swiss, no action from the Swiss. So the Swiss franc had no action, but we still put it in perspective, right? And this will clear up in a moment because I will hide all the drawings. Because as you can see, they move in tandem. One is sometimes outperforming the other, but what can we also look at? The dollar. The dollar is important. And it's already inverted. So the dollar is the most important driver. And this is the funny thing because I go on a 5 minute, and this is the dollar inverted, right? So just look now, look how clean this bottom edge actually is. The dollar is starting to, because if I go out a little, it's not as divergent. I mean, it is pretty divergent at the while. Sometimes more or less, right? Like for example, this is like when dollar is positive and gold is positive. This is the big problem with the dollar. That's why I don't like to use the dollar on gold. This is the problem. So what I like to do is actually, I like to look like at JPY. JPY is more reasonable. JPY is mostly positive to gold. Also, the American bond market, if you have to invert it, it's also, in this case, negatively inverted in this case, but we're just in different times. The bond market is bullish at the moment. Like it was bullish here from this big open here. Sure, it went back down, and from this point it just went back up again, right? So okay, we can't maybe put too much emphasis on that, but one good driver is the real yields as well. I need to check the real yields. The real yields are actually going down. At least they went up from here. They had higher highs in here, and then they started to drop off. So I'm looking at it wrong, by the way. This is amazing. This should be inverted. So it's actually not, it should be US oil divided by US 10-year yields, and then you have a positive correlation. I'm sorry. So this is right. This is the formula. But there is no real divergence. You just see the prices going down as real yields, the prices going up as real yields go up. But we have kind of like a view. We have the view that we want to be bullish, right? We don't want to be bearish now from this bottom edge here. We have a couple of drivers, and one could be like the Japanese yen. The Japanese yen was bullish that day. So why shouldn't you be bullish on the gold, right? Gold and Japanese yen, they go hand in hand, basically. Like, okay, now there is war. Because of the war, we have to be kind of careful with the whole value narrative. This is the big thing. But you can also look at equities inverted, basically. Like 1 over ES also shows you basically, you just look at the stock market and say, or you just take the ES, not 1 over ES, but just ES, and then you see this is the stock market, the American stock market. It's dropping, right? The American stock market is dropping. What happens when stocks are dropping? Gold prices go up, like risk on prices go up. So we pin it to new scale and we just invert it regular. And you can already see, right? You can already see clearly, okay, equities, they start to fall here in this period. They start to fall, they start to fall. Gold is still at the bottom edge, right? So yeah, this is like the picture. You have to see what it's called intermarket correlation, right? Every market is correlated with each other. If X goes up, Y must go down, right? The more, the better. Like if you have more confluences, like all stocks in the world just go down and gold is currently at the bottom edge, right? And the accumulation that gives you reason to buy it. And you see the yen is driving up, one more reason to buy. You get more kind of reasons to get into the trade. You know, you build your confidence by that. You have an edge, basically. This is the edge. Value is the edge. Like understanding where price is and then acting on what you see, like value, like from a value perspective, right? So this is like the value perspective. This is the most important because this gives you, this is the why. This is the why, the value, right? You say, okay, stock market is dropping, JPY is rising. This is a risk-off environment. In a risk-off environment, I should be buying gold. I should not be selling gold. Selling gold is stupid, right? So this is why all these people here, they're just wrong, you know, they're wrong. Because what happens is from basically from here, now we can start to analyze, right? Let's just look from here. We get the cross on the EMA. This is like what I like to see. You get the cross. And from here, you say, we took out the first liquidity. And the move is quite toxic, right? On the 1 minute. So now we look at the auction. We look at, let me take this off. We look at the auction, like what is fast, what is slow. This break is fast. This pullback here on 2 candles is slow. This here again is fast. 1 candle down, not much. Series of up candles, big up candles, small series of down candles. Then slowdown period, right? Slowdown period. And what happens is big candle up, break, like break of structure here, break of structure now. Now we say RGL break of structure, high volume break also. This could be a rejection, right? This could be, but it's unlikely because look at the moving average. The moving averages is opening up. It's not so small as it was in the beginning, right? So it's way, way, way bigger. The gap is way bigger, and you likely think, hey, this is just the start probably because we're here in an accumulation. This is probably the markup phase, and I should be getting in the trade now because if I don't get into the trade, I might not get it. So you start to look for buys. You have to kind of get really bad prices, like you have to buy the RGL, right? The RGL is not the bad price, but you have to kind of think, okay, wow, now we break above, right? And once we break above here, there's like no reason to sell anymore. Like you can only be a buyer. Like you can try to buy here, for example, yes? You can buy here, but you have to be careful. Why? Because we hit the measured move from the big balance area, right? So in this case, you see this big balance area, this swing low and this swing high, this was the measured move. And what happens when we hit the measured move? There's always profit taking. That it's not always a reversal, especially not when the moving averages are still twice the size like in the beginning, right? So the moving averages are still, it's the 20 to 100, right? This is the 200, this is the 20, and they both show into one direction. They show into this direction. So you are above this green line. These are pointing up. You get this fast trending move. You need not to think about where can I fade. We need to think where can I join, right? And this is where we try to get into the 50 pullbacks from a balance area. In this case, we have a swing high now here. This is a swing high because we get a pullback. But as you can already see from the swing high and this last low, right? We just hover above the 50. Like this 50, I'm not claiming it's magic, right? It's just the 50. It's just that the sellers are too weak. The sellers cannot bring the price down at the moment. It's just not possible. And what happens? There's a big volume candle here at the POC of this big candle, basically. And we hold above it, The volume is again getting smaller. And what happens? We get another break up, right? And at this point, you can even try to buy breakouts, in my opinion, because, or at least try to buy down candles, right? Think like a commercial trader. A commercial trader now just thinks, hey, you know what? I'm buying all these stumpy little candles because why wouldn't I? Why would there any reason that this would be not a good buy? Right? And they add size even here. Like they're pressing, they're not trying to reverse the market. They have no reason to reverse the market in this case, right? They're just pressing it. They're pressing it higher. The trend is up. They're pressing it here. They're pressing on these down candles. At every red bar, what happens? The market is just going higher after every red bar, right? And at some point, you hit an extreme price. Amazing. Finally, we hit an extreme price, the order block. Now, do you want to start to press these candles? No. Why? They start to get big. This is not a big candle. 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 These are not big candles, right? But now at the top edge, you start to see this candle. You start to kind of think about the buy side, right? You start, okay, the trend is still massively up, right? But I don't like the size of this candle. Like this candle size is kind of spooky. So you wait for a swing low. You wait for the next swing low. The next swing low is here, and you say, okay, I get swing high, swing low. Where's my 50? 50 is here. You say, okay, I want to buy the 50. I don't want to buy below the 50. It's too dangerous. And what happens? Price holds above the 50, takes out the top edge one more time, but rejects, right? So it rejects, and this is already where we can say, level 2. We can say, okay, this is now level 2, right? Because it did not hold above this price. It actually rejected because we're also coming into the market close. But now we have kind of our bias, right? We know, okay, the last trade was a level 2 rejection top edge, probably due to profit taking, and we will see perhaps on Monday a trade up higher and then perhaps a trade lower, right? But we don't know that. But what we do know is we have to take advantage of these kind of Momo trades. These Momo trades are important because this is the pro trade, right? Somebody is informed money. They know that this is a buy trade. They just know it's a buy trade. And you have to kind of the latest information, like you are the last, you're the last person who gets this information, and you have to do the best out of it, basically. Like you can be aware of all this, but you have to also act upon it, right? You have to act upon all this knowledge that I'm just giving you now because it's useless. It's useless because these moves, they will just get stronger with the time. Gold will not get less volatile now in these times. It will just get more volatile. So you can expect more moves like this one. So I'm just going to delete everything, right? And so you can see this here is a repeated pattern, right? It's always high time frame key level. It doesn't matter what that level is. It could be an order block, RGL, and fan value gap, 50, 25, a 0 level. Important is to realize that there is one way and two way, and again, one way. And this is all the market does. The market goes from, in this case, one way to sideways to two way, back into one way in different manners, right? It's not always like textbook, but this is gold, right? I can use oil for this example, and you will see the same thing. You will see that we get a down move, then we get a slowdown, like sideways up, and that's it. Like, and this is Friday, right? And I remove everything and I just go to a random day, and I'm not even looking. Like here, for example, same thing, right? Market goes what? Here, market goes what? Market goes down. This is now on a bigger time frame. Market goes down. Market goes sideways. Market goes lower on high volume. We know commercial activity must be commercial activity. What are they doing? They reverse the market, right? because they did buy this one, right? But they also bought a lot of in here, right? They bought a lot in this middle area, and they bought on every single dip lower until this move happened. And this is the whole model, right? This is the whole model. Like, it's not so hard to understand. It's not really hard to understand because once you look at only like big volume candles, right? I'm just gonna put everything off. I even put the chart off, right? And I just go here and I say, I bet I know where the next buy trade will be, right? Like, I'm just saying, okay, this is a buy trade. This must be a buy trade. And this must be a sell trade. Just based on observation, I think this is a buy trade and this is a sell trade just because of the volume, right? And then I go to my time frame and then I look, is this a buy trade? Yes, it is. Is it good? No, it's not. Why? Because it's just the start of a buy trade. Is this a sell trade here? Well, in this candle, no. Why? Because it's just the start of a sell trade, right? It's just the starting point. Because price goes higher and starts to sell here. So do you want to sell these candles immediately? No. You want to wait. You say, okay, I see the volume. I'm expecting the buy trade, but I need other things that kind of confirm my buy trade, right? Like the 1 to 3 fade. I say, okay, wow, I got 1. Now I need 2. Then I get 2. And then I get 3. And then you say, okay, I'm going to enter at 3. And then you get your buy trade, maybe, if you're a commercial trader. If you want to trade like commercial. I'm not advising you to trade like commercial, right? But you see, like these volumes, they sometimes, not always, they reverse the market a little bit. Not perfectly, but sometimes you will bottom the market like this, right? You will bottom the market like here, for example, and you will get massive trades. And sometimes you will just get stuck because you also have to combine this knowledge with all the other information that you have. Not only with this, but with many information, right? If I tell you, is this a buy trade? Yes, it is, right? Does it reverse the market? Yes. Does it go lower? Yes, it does go lower. Does it give another volume? Yes, that's good. You think about the big picture, you start to think, if they bought here, what are they going to do if price goes lower? Like here. Or here maybe. And this pin bar, what are they doing with this pin bar? They do indeed reverse the market because that's how they operate, right? They look for these prices. They say, this is an extreme. I have liquidity, I have volume, perhaps I have some value, the dollar is going up. In this case, I can actually start to buy. And this is on all markets. This is just not here. This is also the Nifty 50, for example. If we look at the Nifty 50, oh my God, this is the wrong Nifty 50, I think. I need to Nifty, just Nifty.
Yes,
Yeah,
that is
exactly. This is what we talked about basically. Like you have again, like you see this volume here and you say, interesting. What are they doing with this volume? What are they doing with this volume here? What are they doing with this volume here? And suddenly enough, you find out the next day opens gap up, right? So you already have this understanding. Okay, they bought here, they bought here and here, right? And this is where the market reversed. But why did they buy here? Because this was a level of previous buyers, right? Like obviously somebody had to buy here. There's no volume attached to it, but somebody here reversed the market completely. Like totally up until the top edge, right? And then the whole market goes down again to this level, and then you kind of see this here and you say, this is interesting, right? 10 minutes, good. And you see this and you say, I wonder what they will do here, right? If you have this level marked up, then you already know, okay, you know what? Then you go into the 1 minute, for example, and you start to look. Where is the really, really, really obvious volume spike? There's just one. It's not the open. The open is always full of volume, but you just pay attention to it, but it's not as important as the volume inside the session, right? It's still important. Not saying it's not important, because it can be your RGL basically for the day, because you can say, okay, the market is sell side. I'm Momo selling, right? You're Momo selling, you understand that this is a key level here. You have this key level on your charts, and you say, I'm pressing into this level, right? I'm pressing into it. I'm selling these pullbacks like these guys here, like the prop traders. Remember the prop traders, they're selling pullbacks into level ones. They're selling pullbacks into level ones. But once it gets sticky, right? Like this here, you're out of the trade. You just don't get involved in it anymore. And this is, where does this happen? It happens here, right? Like this is the high volume spike. This is the high volume spike. And the slowdown period basically happens here. So once this happens, you get a swing high and you even get a break, right? And then it starts to get kind of choppy sideways. You get many lows, you get many highs. It's not trending. If you compare it, this is trending. This is just sideways. Many pins at the bottom, pins at the top, in between pins, many pins, many lows, many highs that get stuck, right? So you say, I don't want to be making business here. Why? Because the moving averages is pointing downwards here and it's getting really narrow, right? It's getting smaller, smaller, smaller until there's no business to do. This is now two-way money. This is what we call two-way money, right? But then something sticks out. And then you say, this is interesting. We had this bottom edge here and then this big volume. What is this big volume? And you ask yourself, I wonder what this big volume is. And you just watch it. And you watch it into the close. And you say, okay, interesting, interesting. Pin, pin, pin. Down. Like took liquidity the last time, right? Like remember 1, 2, 3, 1, 2, 3. Like this is, if I go to text, like this could be your 1, or let's say after the volume. After the volume, you want to look. This is 1. And this is then 2, basically, right? This is like after this volume. And you say 2, what are they doing, right? They push the price down on the last minute of the market. Why did they do this? It doesn't make sense. Perhaps it does make sense. I don't know. But
Actually, I guess they want to everybody out of the trade.
yeah, exactly. They didn't, everybody saw probably this volume and said, oh, get me long, get me long, get me long, put their stops in here. They say, okay, yeah, price is going long and people are happy. They say, oh, I will hold overnight. I will hold overnight. This market will gap up, right? What happens? Price goes down, price goes up, price closes at the lowest low, basically, and opens gap up like everybody expected, but nobody got the trade because everybody got stopped out 1 minute before, right? And the market gaps up, and guess what? This is one RGL that you have, right? This is your old RGL basically, and you can already see where the sell trade happened at the old RGL, right? All this business happened at the old RGL. But now the funny thing is we hold above this RGL. We closed above this RGL. So I'm just pointing now out what I think, not what I know. But I'm saying this is turning into a full-blown buy trade. Like seriously, like here, for example, I think this volume at the close, even though it's not so big, this is like still the biggest volume of the day, right? Like from the open, okay, I understand the open is big, right? This could be potentially a buy level, but I'm not kind of expecting this. I'm not expecting that this move will go up because the whole structure of the market at the moment on the lower time frame is bullish, right? So you see this swing high and this swing low is intact. It never broke. This high and this low never broke, right? This low broke this high here. So we have now a new high, and this new high is only as long intact as when this price goes up, right? If this price goes up like here, this is your new swing high, basically. This is like your new arrow, new point. And what you would expect is basically price to come down, this low to hold, like perhaps even here, right? This order block here. I would expect this order block here to trade. Like maybe like this, and maybe not so aggressive, maybe like somehow like this, right? And then just continue the move because the moving averages are buy side, right? Many people are perhaps even stuck in sell trades. Maybe people might perhaps be stuck in sell trades here. You don't know.
Yeah,
Maybe they will
because
squeeze them
of
out.
last.
Maybe because there is also a gap here, right? This is also good. Maybe they will go to this gap here, maybe even beyond, maybe even this liquidity here, and maybe to this RGL here, right? Because this is just an RGL, I just marked it out. It doesn't have to be like that, but this is when we just mark our charts up, we understand this process, we are mindful of this, and now the only key component that we need is, where is the next HTF, I'm sorry, HFT, the next higher time frame key level, right? And on the 5 minute, you won't find the higher time frame key levels. You have to go to the daily and perhaps to the 4 hour. And then you see, you know, this looks like a good level. There's imbalance. There's imbalance. And it's also, if you now take this balance area, like from this swing low and this last swing high, this is the 50. And if you want to be a seller, you can only sell above 50 and below 25. So this is what you're left with. You get this area at 1950. You have to note these kind of prices. This is also important. You have to note these 1950 prices and 1925 and 19 wholesale, right? Like, where is 19 wholesale? 19 wholesale is here. 1925 is here, right? So it's interesting that price gapped down below 1900, yeah. Like it gapped down 1900 and the next day it just closed above it, right? So if you think about it, like from trading from key levels to key levels, you would just try to press it until the next price level, right? Like this is the next liquidity level, this is your next RGL, you would try to push price here. And if we hold above this level, then guess what? You would even start to consider pullbacks and push it into the next extreme level, basically. And this is how this ICT market maker model completes itself, you know? Like I know you know how it looks like ICT market maker model. I think there is probably somewhere a photo of that, right? Like this is what market maker buy model looks like. This is like the ICT stuff, but I'm just joking around, you know. But
Yeah.
it is really like that. You have a consolidation. From this consolidation, there is an expansion. From this expansion starts a new consolidation. From this consolidation starts a reversal back to the previous consolidation. Or let's say not consolidation, but key level, because consolidation is a word. Price can consolidate anywhere where there are orders, right? Like this is a consolidation right now. But in the end, we just have to kind of play with ideas and say, okay, why did this buy trade even originate, right? Do we have some value? Let's check 1 minute. This is the final video, by the way. We won't make another one. India VIX. We check the India VIX for 1 minute and we say, do we have value? Pin to nose scale, left scale, reverse the market. Yes, amazing. Who would think like that, right? Who would say we have value on this day? Good. I think it's clear. It's clear why this volume came now in, right? I think this is clear. I don't have to say anything. The chart
Okay.
speaks for itself. The chart speaks
Yeah,
for itself. I mean, I did look at it. I just looked at it now, but this is something, if you trade Nifty, look at India VIX, put it on your charts and invert it, basically, right? Don't look at it like this, but you see price is dropping, VIX is dropping. This doesn't make sense. When VIX is dropping, price should be rising, like here, for example. Where is it? Let me cook. Like here, right? It should be well adjusted. Price should look like this. It should never look like this. If you see this, this is your edge, basically. This is your bottom edge. This is the commercial trade. So yeah, man, I wish you a nice
okay.
day, and maybe
Yeah,
we
yeah,
can chat in the afternoon or something. Let's
yeah.
see.
Okay, thanks.
Okay,
Thanks
nice.
for the
Awesome.
session.
Bye bye. No
Yeah.
problem. We see you.